There's a pattern in silver markets that has created three of the most explosive price surges in the last 50 years. And right now in 2025, we're watching that exact same pattern unfold stage by stage, signal by signal, almost like the market is reading from the same script that produced catastrophic squeezes every single time before. In 1980, silver went from $6 to $50 in less than a year. The Hunt brothers cornered the market. Industrial users panicked. The squeeze was so violent it nearly collapsed the commodities exchange. In 2011, silver exploded from $18 to $49 in 8 months. Physical demand overwhelmed supply. Premiums hit 30%. You couldn't buy silver anywhere at any price. The shortage was real. In 2020 to 2021, silver jumped from $12 to $30 in 9 months. Reddit traders, industrial demand, and supply chain chaos created a perfect storm. Mints ran out, dealers had nothing to sell. The market broke 3 times. 3 massive squeezes. 3 identical patterns, all following the exact same sequence. And here's what should get your attention. We've already completed 2 of the 4 stages. We're not approaching the pattern. We're inside it right now. This is the story of how silver squeezes form, why they always catch everyone off guard, and why the setup today is bigger than anything we've seen before. And it's developing faster than most people realize. Before we go through the pattern, you need to understand what a silver squeeze actually is, not in theory and practice. What it means when the most volatile commodity market in the world runs out of physical metal. A silver squeeze doesn't start with price. It starts with a structural imbalance. Industrial demand increases, investment demand increases. But mining production can't respond quickly. Silver mines take 7 to 10 years to develop. You can't just decide to produce more silver next month. At first, the imbalance is invisible. Prices are stable, premiums are normal. Inventory looks adequate. But beneath the surface, the foundation is cracking. Available supply shrinks, the float gets tighter. Large buyers start accumulating. Then comes the acceleration. Premiums spike on physical metal. Delivery delays extend from days to weeks. Dealers stop offering prices. And suddenly the paper market and physical market disconnect completely. Futures contracts that were supposed to represent real silver become obviously fictional. The COMEX vaults that were supposed to have metal start getting drained. Industrial users who thought they could always buy silver discover there's none available. That's not theoretical. That's what happened in 1980, 2011, and 2020. And it happened because the market created exactly the same conditions we're seeing now. A tight supply situation, massive paper leverage, and growing physical demand. They believed paper silver was the same as physical silver. They assumed supply would always be available. And they refused to accept reality until the squeeze was already underway. Let's look at how it actually happened 3 times the exact same way. Let's start with the first modern silver squeeze, 1979 to 1980. This is the original blueprint. In the 1970s, silver was boring. It traded around $4 to $6 per ounce. Industrial demand was steady. Investment demand was minimal. Most investors didn't think about silver at all. Then 2 Texas billionaires, Nelson Bunker Hunt and William Herbert Hunt, had an idea. They looked at silver supply and demand and realized something. There wasn't much available. Mining production was limited. Government stockpiles were being drawn down. Industrial demand was growing. If anyone started buying aggressively, they could move the price. And this is where the pattern begins, with a market that looks stable, but has hidden fragility. Stage 1 supply deficit emerges. By 1975, silver mining production was roughly 250 million ounces annually. But industrial demand was 300 million ounces. The gap was filled by government stockpiles, mostly U.S. strategic reserves built up during World War II. But those reserves were finite, and they were being depleted. The Hunt brothers saw this. They started buying silver quietly in 1973. Physical bars, futures contracts, mining shares. By 1979, they controlled an estimated 100 million ounces. That was half the annual global mining production. Just 2 guys, they didn't disclose it. They didn't announce it. They just kept accumulating while everyone else was ignoring silver. Stage 2, industrial users get nervous. By mid-1979, silver prices started rising. 6, then 8, then 10. Industrial users, companies that needed silver for photography, electronics, and manufacturing, started to worry. They'd always assumed silver would be available at $5 to $6. Now it was 10 and climbing. They did what any rational buyer does when they think prices are going higher. They started buying ahead, not just for current production but building inventory. 6 months of supply became 12 months. This increased demand by 50% overnight. The available float got even tighter. Stage 3, the paper market breaks. This is the critical stage. The stage where the squeeze goes from price increase to catastrophic shortage. The COMEX, the commodities exchange where silver futures trade, had a problem. There were far more paper contracts than physical silver. Futures contracts are supposed to be backed by real metal. Most traders never take delivery. They just trade the contracts. But the Hunt brothers were different. They kept taking delivery. Every contract they bought, they demanded the actual silver. By January 1980, COMEX silver inventories were collapsing. The exchange had 120 million ounces in registered vaults. The Hunts and other big buyers held contracts representing 280 million ounces. The math didn't work. If even 50% of contract holders demanded delivery, the exchange would default. Silver hit $21 in December 1979, then $35, then $45. By January 17, 1980, silver peaked at $50. It had gone up 10x in 12 months. Premiums on physical silver went insane. If the paper price was $50, dealers were charging $55, $60, $65. Why? Because there was no metal available. The COMEX was nearly out. Refiners were backed up for months. If you wanted silver, you paid whatever it took. Stage 4, forced liquidation and collapse. The COMEX did something unprecedented. They changed the rules mid-game. In January 1980, they announced liquidation-only trading. You could sell silver contracts, but you couldn't buy new ones. This was designed to break the squeeze. Force the Hunt brothers and other big holders to sell, and it worked. The Hunts couldn't roll their positions forward. They couldn't buy more contracts, and they were leveraged. When silver started falling, they faced margin calls. Massive margin calls they couldn't pay. They had to liquidate. Silver crashed from $50 to $10 in 2 months. The fastest commodities collapse in history. The Hunts went bankrupt, but here's what people forget. The squeeze was real, the shortage was real. The COMEX nearly defaulted. They only stopped it by changing the rules, by making it impossible to buy. If they hadn't intervened, silver would have gone to $100, $150, maybe higher. Because there was no physical metal available at any price. That's what a true squeeze looks like. And the conditions that created it, a supply deficit, industrial demand, and tight physical availability, those conditions keep coming back. Let's jump forward 30 years. Silver 2010 to 2011, the stealth squeeze. After the 2008 financial crisis, everything changed. Trust in the financial system collapsed. Central banks started printing money. Investors looked for alternatives to the dollar. Gold got all the attention. It went from 800 to 1900. But silver was following quietly behind. In 2008, silver bottomed at 888. By 2010, it was back to 18. Decent gains, but nothing crazy. Most investors still ignored it. But the pattern was forming again. Stage 1, supply deficit emerges. Global silver mining production in 2010 was about 735 million ounces. Industrial demand was 665 million ounces. Investment demand was 200 million ounces. Total demand was 865 million ounces. The deficit was 130 million ounces annually. Where did that metal come from? Recycling and government sales. But government stockpiles were gone. The U.S. had sold off its strategic silver decades ago. Recycling couldn't fill the gap. The market was structurally short, and nobody was paying attention. Stage 2, industrial users get nervous. By late 2010, silver was at 25. Industrial users started getting concerned. Solar panel manufacturers, electronics companies, medical device makers, they all needed silver. And suddenly it wasn't cheap anymore. They started buying ahead, building inventory, securing long-term contracts. This pulled even more physical metal out of the available supply. The float tightened. Stage 3, investment demand explodes. This is where 2011 was different from 1980. It wasn't two billionaires cornering the market. It was millions of regular investors buying coins in small bars. The U.S. Mint sold 40 million silver eagles in 2010. In 2011, they couldn't keep up with demand. They sold out repeatedly. Premiums spiked. A silver eagle that should have sold for $2 over spot was selling for $5, $7, $10 over spot. Dealers ran out of inventory. Refiners had 6-month waiting lists. You could see the price on your computer, $35, $40, $45 per ounce. But you couldn't buy physical silver at that price. The paper price and physical market had disconnected. On April 28, 2011, silver hit $49.80. It had almost tripled in less than a year. And just like 1980, the available physical supply had vanished. Stage 4, forced liquidation. The COMEX raised margin requirements 5 times in 2 weeks. They made it prohibitively expensive to hold silver futures contracts. This forced speculators to sell. Silver crashed from $49 to $26 in 3 weeks. But again, the shortage was real. The industrial users who needed silver paid the high prices. The investors who wanted physical metal couldn't find it. The squeeze happened. The only question was how high the price would go before the exchange intervened. Now let's look at the most recent example. 2020 to 2021, the Reddit squeeze. In March 2020, COVID hit. The world shut down. Stock markets crashed. Silver fell to $11.77 and then the stimulus started. Trillions of dollars pumped into the economy. Silver started climbing 15, 18, 24. By August 2020, it hit 30. But this squeeze was different. It was driven by retail investors who understood the pattern. Stage 1, supply deficit emerges. COVID shutdowns disrupted silver mining. Peru shut down mines. Mexico shut down mines. Global production dropped by 50 million ounces in 2020. But industrial demand came roaring back. Solar panels, 5G technology, electric vehicles, all of them need silver. Investment demand exploded. People wanted hard assets. They didn't trust the dollar. They were buying gold and silver to protect themselves. The structural deficit got worse, way worse. Stage 2, physical shortage becomes obvious. By July 2020, you couldn't buy silver. Dealers were out of stock. The US Mint couldn't produce enough coins. Premiums went crazy. Silver was $25 on the COMEX, but silver eagles were selling for $40 if you could find them. The disconnect was blatant. The paper market said silver was $25. The physical market said $40. Which price was real? Stage 3, social media coordination. In late January 2021, a movement started on Reddit. Wall Street silver, silver squeeze. The thesis was simple. Silver is the most manipulated market on Earth. The big banks hold massive short positions. If enough people buy physical silver, the shorts will get squeezed. The COMEX will run out of metal. The price will explode. Hundreds of thousands of people started buying. Not futures contracts, physical metal. Coins, bars, anything they could get. Dealers sold out in days. Premiums spiked even higher. Silver jumped from $25 to $30 in a week. Stage 4, the squeeze stalled. But this time the squeeze didn't fully develop. Why? Because the COMEX still had metal. Not a lot, but enough. And the big buyers, the industrial users, didn't panic like they did in 1980 and 2011. The price fell back from $30 to $22 over the next few months. The squeeze faded, or did it? Because here's what actually happened. The physical shortage never went away. Even in 2024, premiums on silver eagles are $6 to $8 over spot. Dealers have limited inventory. The mints can't keep up. The disconnect between paper and physical is permanent now. The squeeze didn't fail, it just hasn't finished yet. Because the pattern isn't over. We're not at stage 4, we're at stage 3. And stage 3 is where it gets dangerous. Here's where we are right now, December 2025. Silver is trading around $30 to $32 per ounce. It's up from $20 in 2024, but it's not getting major attention. Gold is hitting all-time highs above $2,600. Bitcoin is making headlines. Silver is the forgotten metal. Again, but the pattern is forming, just like it did before. Let me show you exactly where we are. Stage 1, supply deficit emerges. Check, we're already here. Global silver mining production is approximately 830 million ounces annually. Industrial demand is 550 million ounces. Investment demand is 250 million ounces. Total demand 800 million ounces. That looks balanced, right? Wrong. Because those numbers don't include what's happening with solar panels. Solar panel production is exploding. Every panel needs silver. In 2020, solar used 100 million ounces. In 2024, it used 160 million ounces. By 2030, projections say 300 million ounces. That's an additional 140 million ounces of demand in 5 years. Where is that silver coming from? There are no new major silver mines opening. Recycling is maxed out. Government stockpiles are gone. The deficit is structural. It's not temporary. It's getting worse every year. Stage 1, complete. Stage 2, industrial users get nervous. Check, we're here right now. In 2024 and 2025, major industrial users started securing long-term supply contracts. Solar manufacturers in China are buying years ahead. Electronics companies are building strategic reserves. They see the same data we do. They know a shortage is coming. When big industrial buyers start hoarding, that removes metal from the available supply. The float gets tighter. Smaller buyers get squeezed out. Premiums start rising. We're seeing it now. Silver eagles are selling for $8 to $10 over spot. Generic rounds are $4 to $6 over spot. Those premiums should be $2 to $3 in a normal market. We're not in a normal market anymore. Stage 2 is underway. Stage 3, the paper market breaks. This is where we are right now. The stage where everything accelerates. The COMEX reports approximately 280 million ounces of silver in registered vaults. That sounds like a lot. But open interest in silver futures contracts represents over 900 million ounces. The leverage ratio is 3.2 to 1. For every ounce of physical silver, there are 3.2 paper claims. Now, normally this isn't a problem because most traders never take delivery. They settle in cash. They roll contracts forward. They're just speculating on price. But what happens if physical buyers start demanding delivery? What happens if just 30% of contract holders say, I want the actual metal? The COMEX defaults, there isn't enough silver. And we're starting to see the early signs of stress. In November 2024, COMEX silver inventories dropped by 40 million ounces in 6 weeks. That's the fastest drawdown since 2021. Why? Because big buyers are taking delivery. They're pulling metal out of the exchange. Every ounce removed makes the remaining leverage higher. At some point, probably soon, the market realizes there isn't enough physical silver to back the paper contracts. That's when the squeeze goes exponential. Here's why this setup is bigger than 1980, 2011, or 2020. In 1980, it was 2 billionaires. When they were forced to liquidate, the squeeze ended. In 2011, it was mostly retail investors. When the COMEX raised margins, they sold, and the squeeze ended. In 2020, it was a social media movement. It was organic, but it lacked coordination. The big money didn't join. But now in 2025, it's different. Institutional buyers are accumulating silver. Not for speculation, for strategic reserves. Countries are buying China, Russia, India. They're moving away from dollar assets into commodities. Silver is on that list. Central banks are buying gold, but private institutions and sovereign wealth funds are buying silver. Family offices, hedge funds, billionaires who understand the deficit. They're not buying paper contracts. They're buying physical metal and storing it outside the banking system. This is patient strategic accumulation, and it's relentless. At the same time, industrial demand is accelerating. Electric vehicles need silver. Infrastructure needs silver. Solar panels need massive amounts of silver. This isn't speculative demand that disappears when price rises. This is structural demand. These industries cannot function without silver. If the price goes to $50, $75, $100, they'll pay it. They have no choice. And then there's the retail investor. The Wall Street silver community didn't go away. They've been buying for 4 years straight. Hundreds of thousands of people buying coins and bars every month, slowly, quietly removing physical metal from the market. They're not selling when the price dips, they're buying more. This is a three-front war on available silver supply. Institutional buyers, industrial users, and retail investors, all competing for a finite amount of physical metal. And the mining supply can't respond. You cannot build a silver mine in a year. It takes a decade. Even if silver hits $100 per ounce tomorrow, production won't increase until 2030 or later. The deficit is locked in. Here's what happens next. Stage 3, the breaking point. We're in this stage right now. Premiums are rising. Delivery times are extending. Small dealers are struggling to source metal. The big dealers are fine for now, but their inventory is tighter than it's been in years. The COMEX inventories are falling. Not crashing yet, but falling steadily. At some point, probably in the next 6 to 18 months, something breaks. Maybe it's a large industrial user who can't source metal. Maybe it's a country that demands delivery of a massive futures position. Maybe it's just the slow accumulation reaching a critical threshold. But when it breaks, it'll break fast. Premiums will spike to $15, $20, $30 over spot. Dealers will stop offering prices because they won't have metal to sell. The COMEX will face a delivery crisis, and the paper price will become obviously fictional. You'll see silver quoted at $40 on your screen, but you won't be able to buy physical metal for less than $70. That's the disconnect, that's the squeeze. Stage 4, the price explosion or forced liquidation. This is the unknowable stage. In 1980 and 2011, the exchanges intervened. They changed margin requirements. They made it impossible to keep buying. The price crashed, but could they do that today? If sovereign buyers are demanding delivery, can the COMEX just say no? If industrial users need silver to keep factories running, can you stop them from buying? If millions of retail investors have already pulled their metal out of the system, who's left to sell? The dynamics are different this time. The buyers are stronger. The deficit is bigger. The leverage is higher. There are two possible outcomes. Outcome 1, the exchanges intervene again. They raise margins. They go to cash settlement only. They force liquidation. The paper price crashes, but physical metal stays expensive. The market splits permanently into paper and physical. Or outcome 2, they can't stop it. The squeeze runs its course. Silver goes to 75, 100, 150. It stays there until new mining supply comes online, which takes years. Industrial users pay whatever it costs. Investors who own physical metal see generational gains. And everyone who thought silver was just a boring industrial metal learns what a real commodity squeeze looks like. Which outcome happens, I don't know. Nobody does. But the pattern says we're not staying at $30. The setup is too extreme. The deficit is too large. The leverage is too high. Something has to give. And when it does, the move will be violent. Not gradual, violent 50% in a month. Double in 3 months. That's what happened every time before. There's no reason to think this time will be different. This isn't a prediction, it's pattern recognition. 3 times in 50 years, silver has followed this exact sequence. Supply deficit, industrial hoarding, paper market stress, explosive price move. Every single time people said it couldn't happen. Every time the market looked stable right until it wasn't. And every time, the people who recognized the pattern early made enormous gains. The people who waited until the squeeze was obvious paid $50 for something that was $20 a few months earlier. We're at stage 3. The deficit is real. The COMEX inventories are falling, the premiums are rising. The industrial buyers are nervous. The only question is timing. Maybe we have 12 months before stage 4. Maybe 6 months. Maybe it's already starting and we just don't see it yet. But the pattern says it's coming. And when silver squeezes, it doesn't give you time to react. It goes from $30 to $60 in 6 weeks. By the time you realize what's happening, physical metal is unavailable and the paper price is meaningless. 3 squeezes, 3 identical patterns. 1980, 2011, 2020. Each one started with a supply deficit that everyone ignored. Each one ended with a price explosion that shocked the market. And each time, the people who understood the pattern positioned themselves early. We're watching it happen again right now. The stage 3 signals are flashing. The leverage is extreme. The deficit is structural. The buyers are relentless. Maybe this time the exchanges will stop it before it goes exponential. Maybe they'll change the rules again, but maybe they can't. Maybe the forces in play are too large to control. Maybe the deficit is so severe that no amount of intervention can prevent the squeeze from running its course. The pattern doesn't tell us which outcome. It just tells us we're not staying here. Silver at $30 with these fundamentals is not an equilibrium. It's a coiled spring. If this showed you the pattern you weren't seeing, subscribe. Because when stage 4 hits, when the squeeze from theoretical to actual, you'll want to understand exactly what's happening and why. The market will act like it's shocked, but it's not a shock. It's not a surprise, it's a pattern, and the pattern has already told us what comes next. We just have to be willing to see it.